My name is Aman and I'm a CPA practicing in the Metro Vancouver region of British Columbia, Canada. In this video, I will talk about the taxability of assets transfer between family members. You see, whenever we deal with related parties, especially from the tax angle, the CRA is worried that the transaction does not relate to an arm's length transaction. Now, you might ask what arm's length means. Although the term arm's length is used throughout the Income Tax Act, the Act does not contain any precise definition of the term. As I want my video to be simple and understandable, I will not focus on the technical definition from my point of view. The arm's length means someone who is not required to act and there is no tie or bond. On the other hand, a non-arm's length, for example, if your kid asks you for money, you might feel obligated to act. You have a motivation which is not based on your interest. There is a kind of a tie or a bond, a relationship which makes you to act. The suspicion is always that the transactions might be done at a beneficial rate. So maybe you are doing something in particular to meet your goals. So the worry here is whether you may be trying to pass on some of your worldly goods to your family members at a rate where you are trying to avoid taxes. So I'm talking about spousal transactions, transactions with children, transactions with brothers and sisters, etc. So when you deal with non-arm's length transactions, there are a specific set of rules that are in place. It becomes your problem to prove you did act at arm's length. The burden of proof is on you. You need to be very careful while doing transactions with family members because many negative tax consequences such as double taxation come into play when you do not act at arm's length. Let's discuss the dangers of double taxation. In the context of this video, double taxation is when you don't get credit for having paid tax or get double penalized because you paid the wrong amount in tax. So double taxation is to encourage taxpayers to do transactions at fair market value, which avoids the double taxation issue, thereby preventing them from trying to avoid taxes. Let me give you some examples of non-arm's length transactions. Let's say Mark has 100 shares of a tech company that have a fair market value of $10,000 and a cost of $2,000. Mark is currently in the highest tax bracket and he thinks that his shares value is going to grow in the future. Mark starts thinking, I don't want to hold these shares and I want to give them to somebody in my family so that they can benefit from the shares. Let's say Mark wants to sell the shares at fair market value. He says to his brother, Tom, I have a really good deal for you. Buy the shares at fair market value and in a couple of months from now, they will be worth more. So first of all, brother is blood related, a direct relationship. So absolutely, this will be defined as a related party, that is a non-arm's length in this scenario. You see, the definition of fair market value is what an arm's length person is willing to pay. To protect himself from CRA, he should be able to come up with a market quote or a broker statement to indicate the share's fair market value. So in this case, what ends up happening is that the deemed proceeds will be the amount which he actually receives. And on the other side, Mark's brother gets the deemed cost of acquisition at what he paid. So because both Mark and his brother Tom are getting credit for what was received or what was paid, there is no double taxation in this case. So this will be an example of what CRA says that you should do. That is, always try to do the transaction at fair market value. Let's take another scenario. In the same example, Mark loves his brother so much that he feels that since he's so successful, he does not need to get anything in return for the shares from his brother. And so he just gifts the shares to his younger brother. Well, you might be surprised that this is not a bad option. The sale proceeds will be deemed to be at fair market value, but the good thing is that the cost will also be deemed at fair market value. And so in this case, again, there is no double taxation. However, Mark will have an immediate tax consequence, and that is part of the problem. He will have to pay taxes on it with no income, as he just gifted the shares. In the third scenario, let's say he is indifferent to his brother. He is going to trick him actually, and so he is going to say, oh, I have a situation where I have shares and the shares will double the value in a couple of months, let's say. But you know what? I'll let you have them at a particular sum of money. Suppose Mark sells the shares to the brother at more than the fair market value. In that case, the issue is that the sale proceeds will be deemed to be at actual value. So Mark will pay tax based on the actual sales value. So let's say the shares were worth $10,000. Still, he makes his brother pay $12,000. In that case, Mark will be charged to tax based on the sales value of $12,000. However, for his brother, the cost will still be $10,000, even though he paid $12,000. That's not fair, right? Which means he loses $2,000 from the cost. So when Mark's brother sells the shares later, let's say at $20,000, he will have to pay the tax on the capital gain. That is $20,000 minus $10,000, which gives you $10,000, instead of the difference between $20,000 and $12,000, that is $8,000. So in this case, there is double taxation, because for that $2,000, they have to pay tax on it twice, as Mark is paying tax on $12,000 and the brother is only getting the credit for $10,000. So that was the example for Mark and his brother. Now, things get a little bit different when we talk about Mark and his wife Mary. So when it is a spouse, there is always an assumption that transfer has happened at the original cost. So there are no tax consequences. It is a tax-free rollover. You see, the tax implications are deferred until the sale is made to an outside third party. You see, unlike the USA, we don't see the husband and the wife as one for tax purposes here in Canada. In the United States, you have to file one tax return for a married unit. In contrast, in Canada, each person needs to file their own taxes. Suppose you're trying to set off your losses and you want to trigger a capital gain to do the set off. In that case, you can do it by electing out of the rollover. You see, you can elect not to have the spousal transfer at cost. Beware, once you do the transaction, you cannot just go back and elect out of the rollover. So you will need to elect out of the rollover before the transaction actually happens. Another thing to keep in mind here is that if Mark sells the shares to his wife at a value other than the fair market value, there might be income attribution. Even if he gifts the shares to his wife, there will be income attribution. I don't want to go into too many details about income attribution in this video, as I want to keep the video short. To give justice to the topic of income attribution, I will discuss the income attribution rules in a separate video. If you want to be notified about our new tax updates, please consider subscribing to our YouTube channel. Thanks for watching and see you in my next video. Until then, bye.